So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to The Daily Call. Today, we're going to be talking about why recency bias is killing your potential to be successful. This one is a popular one for me, and one that I am truly fascinated with. I continue to be fascinated the longer and longer I run Option Alpha with just the psychology of most investors and the psychology of trading, in particular, how it affects options trading and how people become successful or not trading. And recency bias, I think, is one of the true silent killers of options traders. And the whole idea of recency bias is that recent events or past events are going to affect our new decisions that we make. And the reality is that we all know, and we've talked about before, that we are creatures of habit. Our brains are hardwired to do things that require less cognitive strain on our brains. So we get up in the morning and we tie our shoes the same way, we go to work the same way, we brush our teeth the same way. We are creating habit loops in our brains so that we don't have to think about doing things. I mean, like, when's the last time you thought about driving, right? That you really cognitively thought about what you were doing and how you were steering the car. You don't. You have a lot of habits that your brain has created. And one of those habits that is basically in there is the idea that recent events or past events are going to affect new decisions. So if you burn your hand, you're going to think to yourself, well, I probably shouldn't put my hand on the stove because I'm going to burn my hand, right? So this then trickles over or spills over into investor psychology a lot. And what happens is that if investors get into the stock market and they do really well, then they have this recency bias that all of their positions will do well. They might overallocate. They might, get into a position that they shouldn't have because the past position that just happened a month or two or a week ago did really well. So they have this, false expectation, this false positive that things are going to go well. The same thing can be said during down moves or drawdowns in your account. So if you have, let's say, a bad string of trades, like 2 trades in a row or 5 trades in a row even, that do really bad, those recent events, those recent trades are going to more heavily weigh on your decision to keep trading or to keep trading that strategy. The reality is, though, is that none of that really matters, especially when it comes to options trading and high probability expected outcome systems like this, because any one given event does not have a dramatic impact on the future expected outcome. So if I lose on my first trade of the week or my second trade or even third or fourth or fifth trade of the week, that really has no bearing on that strategy until we are making hundreds and hundreds of trades. So the expected outcome doesn't change because we had a string of bad trades or a string of good trades in either case. But what people often do is they often relate that this expected outcome only works if the first few trades do well. So if the first few trades don't do well, then everything that I've said about expected outcome, high probability of success is basically garbage. It doesn't work, right? But that's the recency bias kicking in. Your expectation that recent events are going to dictate future events, when that's not true. Each individual trade is an independent event of the previous trade. And no matter how many times people try to disprove this, the reality is that when you are trading in a highly efficient, highly liquid market like this, we don't know what the sequence of returns you're going to have. So the focus should always be on the end game. It should be on the expected outcome. That's why we built our backtesting software, which you can get to at optionalpha.com/toolbox, so that you can backtest a strategy and optimize a strategy before you get into the trade, before you start even making that first dollar investment. So you have a pretty good idea of what it could look like in the future if that setup that you're doing now does see drawdowns, or what the win rate is, or when you should be taking profits. That's why we built that. So you have this future endpoint to be looking at and to be monitoring. It's also why we built our auto trading platform, because for me, I want to totally remove myself from the equation. So there's still a lot of, emotional and perception, I guess, on my side from a human standpoint, that we can still remove with auto trading. And so auto trading is going to be amazing because now we can take recency bias that we have to feel and have to visually go through and have to click through. We have to close out of, trades that are losers. We have to wait for trades to come back around and become winners before we close them. That's all out the window now. With auto trading, All of that happens automatically. So we don't have any impact or any influence on what should be a very systematic, very rigid process that can be done by a robot. A robot can make these trades trading against or towards the expected outcome so that we have trades, we have setups that should meet our requirements for income, for returns, for drawdowns, for everything in the future. And we just let it go. And we sit back and we just have to be monitors and patients of that system. So hopefully this helps out. Hopefully it kind of, again, got your mind thinking a little bit differently today, because recency bias is really one of the things I see often with traders, especially new traders, that they get themselves caught in. It's a trap that you fall into, and it can lead you into not trading or trading the wrong way in some cases because of just the past couple trades or the past couple months. But again, it has no impact or no real bearing on future expected returns when you are in a high probability system like the one we teach. So hopefully this helps out. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.